Hello and welcome to this wide debate on managing the risk of non-advised drawdown. Since the pension freedoms took effect, a host of providers have launched drawdown products sold directly to customers. But how have these non-advised investors fared? What can providers do to help customers manage their money and protect them against falling markets? And how can retirement advisors prove their value in the new world? To answer these burning questions, I'm joined by Simon Massey, Wealth Management Director at MetLife, Tom McPhail, Head of Retirement Policy at Hargreaves Lansdown, Billy Burrows, Director at Retirement Intelligence, and Nick McBreen, an IFA at Worldwide Financial Planning. We are streaming this debate live, so if you have any questions for the panel, please tweet us using the hashtag #MMWired. Simon, I'd like to come to you first. So before the freedoms came in, lots of providers offered drawdown, but it had to be through an advisor. What's changed to make them launch these non-advised products?
I think what's fundamentally changed, Sam, is the fact that with pension freedom, obviously consumers are now allowed access to their pension fund. They don't have to buy an annuity, and that attractiveness of being able to get your hands on the money for what might be many various purposes, helping the kids on the housing ladder, enjoying a holiday, upgrading house, whatever it might be. That's a very attractive draw for people. So I can see the sort of consumer demand towards wanting access to money and therefore the desire to enter drawdown. I think what's less clear is whether the customers that are taking up these offers are aware of the risks that they are now carrying on their shoulders that have previously been carried by insurers, who frankly are the experts in risk management. So I think there's a bit of a dilemma there for them, but I can see the attractiveness of pension fund access for a consumer.
Let me put it another way then, I suppose. What do you think was stopping them before? What were the risks that they thought, actually, we don't want to be in this space?
Well, I'm not sure the risks are always articulated and the choices that clearly articulated. I think your typical wake-up pack from a provider would have highlighted the annuity option, somewhere given the option of shopping around for a different annuity through the open market option. Some commentators might say not very clearly, but it was certainly in the pack. And probably less commentary around the drawdown option. So I think to a certain extent there was some shepherding of consumers towards a particular solution, rightly or wrongly. And there's been, annuities have been around a long time and have evolved as a proposition, and a well-sourced annuity for the right customer does deliver value. So I think there are some reasons why the annuity was the option, and it's shifted away from that. I think the key issue though is, do consumers really understand the risks?
So then let's come to you. So Hargreaves probably sell the most direct drawdown out there. You've done some research on the first sort of wave post-freedom customers. What does that tell us about what people are doing?
That's right, and I think it's still too early to draw firm conclusions. So I think we have to acknowledge that, and this is still very much a work in progress. It's interesting looking at the FCA data that the transaction patterns now seem to be starting to settle down. So we're starting to see what the new normal looks like. But in the meantime, we looked back at 27,000 self-managed drawdown investors, clients already, Hargreaves Lansdown clients, and we looked back over the last year just to get a sense of 1 year on, how's it going for them. And there were some positive indicators in there. It was really interesting looking at the period immediately after the start of the year, and January, February time, the markets were extremely volatile. So that gave us an opportunity to look at our clients' transaction behaviour. And it was encouraging to find there was no evidence of panic selling, of people seeing the markets plummeting and immediately dumping their investments. That was a concern that some people had expressed. Well, we didn't see any evidence of that, and we looked at the level of income that people are taking, and typically they're taking around 3.5%, 3.6% income. So that too looks like quite a good number. We looked at the investment choices that they're making and the sort of portfolios they're putting together. Typically are beating their sector averages, they're beating the benchmarks. So there's a lot of good stuff there, and I'm not pretending that that's the end of the conversation. I think there's more work we need to do around this. But I think just 1 year in, there's a lot of positive data that we can take encouragement from.
Okay. Billy, Nick, I'd be good to hear your views on whether you think that data, which all sounds great, how representative that is, I suppose, of the wider population, given we've got these are Hargreaves customers, and as you say, it's only a year. So if we could look a bit further ahead and think, how might that change? Billy?
Well, one of the issues, of course, is the advice gap, and obviously a lot of the clients going to Hargreaves will be more sophisticated and savvy. And we mustn't ignore the fact that the decision to put retirement savings into an annuity or drawdown is one of the hardest and most complicated decisions in financial planning, and people need all the help, guidance and advice they can get. And my real fear is that because of the way that the market's developed, a lot of people now don't have access to advice, and that's so dangerous because if people follow their own instincts, follow the sales messages, they can end up in the wrong place, and as we saw, people can actually end up losing a lot of money.
I think it's a very early days to what Tom is saying to make any conclusions from that at all, because I think it's such a big picture that someone, as Billy said and as Tom was outlining, making that decision to go into an investment-based portfolio, stripping out income generating drawdown contract on their own, having made choices from wherever they make them, I have great concerns that we are very early days of potentially a disaster for many clients. If you think about how many people in the UK today, I'm not wearing a legal hat here, but if you think how many people do not have wills in place today, do not have power of attorney in place, they don't even have guardians appointed for their children or executors. That's such an important thing, but people do not do it. So are we saying that those things are okay, but people are capable of making, as Billy said, a fundamental investment decision about where they're generating their income, and it's just coincidental. I was saying to Tom earlier, I just had a long meeting with some clients before this event, and one of the things we were talking about was how do we decide what is the journey, taking money from an investment portfolio, taking money from an ISA portfolio, and perhaps taking money from their pension fund, but if you are reliant upon that as your only source of income, you're raising a whole separate agenda that this may not be appropriate. I'm very fearful for people because they're not informed.
Yeah, can I just pick up on that? Because I would agree with that. And I think if you look at what's happened just in the last year, accepting it's a very short space of time, there will be some people who may have felt that it's not a political point, but the Conservatives in majority government, markets over 7,000, what a great time to be retiring into drawdown. And here we are a year later, potentially with circa 10-15% reduction in the value of their pot, plus year one income. So they could be a 60-year-old having to make their money last 40 years, and a fifth of their money's gone at the end of year one, and they've done it themselves. Now that is a real worry. And this is where I think the point I was making earlier about the understanding of investment risk, sequence risk and longevity risk, which in the hands of a skilled advisor is explained, articulated, understood and where necessary laid off, I think gives customers the best chance of getting a good outcome. I think left to a DIY investor, the chance of it resulting in a good outcome is relatively slim for a typical investor, except there are some more sophisticated folk who probably do understand some of those risks.
I think there's a couple of really interesting challenges coming out of that. And I think for people who want to self-manage, and the reality is that for most people, most of the time, self-managing their finances is the normal state of affairs. Most people typically, on a day-to-day basis, don't need or want to pay for, or shouldn't perhaps, be seeking input from a financial advisor. But we know there are specific points in their lives when that is appropriate. So what we want is a more engaged and more financially sophisticated and savvy population that is able partly to make their own decisions for themselves and also partly to identify when it is that they need to engage the services of a financial advisor to help them. The critical challenge, therefore, I think, for policymakers is to address the good bits that we've got from auto-enrolment, where people are just being passively put into a pension, and all the challenges that come through at the point of retirement, where you have idiosyncratic needs and people have to make decisions and perhaps to take advice, and to start building that bridge between auto-enrolment at one end and the choices at the other end, and how policy changes could facilitate that.
One of the dangers with self-management is that people need a guiding hand, and a lot of people, and I've had real life experience of this, a lot of people who are using the non-advised platforms think they're actually getting a guiding hand, but of course they're not, and by the time they realise they're on their own, quite often it's too late.
I think it's a really dangerous area we could go down here of becoming splitting this out between getting away from the collaborative nature of advice, and I think the regulator is missing this as well. It shouldn't be me saying, Billy and Billy, that's what you got to do. It should be a collaborative discussion, and it might be, and as Simon was saying earlier, it might be that I advise you not to do it. Advice should be as much about not doing something as it is about, drawdown's a really good idea, and off you go.
You're so right. I had a client of mine who said, Billy, for God's sake, give me a one-handed advisor, because on the one hand, you can put your money in an annuity, the other hand in a drawdown. And it's that debate that people really find very valuable. And of course, the real difficulty with non-advised drawdown is that often people are only getting one side of the argument.
Yeah, I think for people who choose to self-manage their investments, it's important also to bear in mind that it's not just at the point of retirement the decisions get made. It's in year 2 and year 5 and year 10, and there may come a moment when, having perhaps partially annuitised at the point of retirement, they might want to come back and more fully annuitise later, or they might want to change their arrangements. And so there are all these ongoing engagement issues which you may choose to pay a financial advisor to help you with, but certainly if you're not, you need to understand some of the risks that Simon was talking about there, and you need to understand the consequences of the decisions that you're taking.
Just jump in here, because I think the point, some people are capable of doing it, that's fine, some people aren't. The missing thing seems to me, how do we work out who's who? I mean, when someone comes to you, what's the suitability process like?
And in part, that's what the second line of defence mechanisms that the FCA came up with are intended to achieve. And so, as a product provider, Hargreaves Lansdown and other insurance companies who are also now distributing drawdown arrangements on a non-advised basis have to walk their customers through a series of questions and challenges, and from time to time say to the customer, actually we're not going to do this business because we're not comfortable with it. And I think that's the area where the safety mechanisms have to kick in, and to provide that customer with the relevant information if they are going to choose to self-manage, to make sure they can do it as effectively as possible. And if there's something really bad looming, potentially to intervene and say, no, look, we need to stop this. And the FCA has set in train a mechanism to try and achieve that. I have no doubt that can be further refined and improved as time goes on.
And I think there's an additional point as well. I mean, I think if an investor has chosen to invest with Hargreaves, that's a conscious choice to move their money, and through the tools available on the website, make their decisions. Now, they may make some mistakes, they may not, whatever. It's a conscious choice. I think that's very different that if you've had a personal pension with a provider for a long time, and through the wording of the wake-up pack are conveniently flowed through to a non-advised drawdown, where you haven't perhaps made the same conscious choices when you've transferred, and possibly not as actively engaged in that process as you could be.
And that's where I think the challenge of readdressing the engagement question and what we can do with the auto-enrolment process and with the memberships of those people who are potentially disengaged today. There's a lot more work to be done there. I think there's also more work to be done around those wake-up packs, and to try and instill a culture of decision-making, of choice, of competition around the point of decumulation.
When you talk about decision making, I've always thought there are sort of what I call 3 golden rules. The first rule is that you shouldn't invest your money in something at risk unless you have capacity for loss and you can weather the storm. I saw someone say that you should probably be able to stomach a 10% fall in the fund value or the income. The second one is that as an investor you must understand the risk, not just superficially, but really understand the risk. And thirdly, you actually need to make sure that you've looked at all of the alternatives. And I'm sure you would agree that people, not enough people, are actually looking at the alternatives that are available.
And that's exactly what advice does. That's exactly what advice does. and someone in isolation who is meeting that situation of a pension fund is available, unless they have that conversation, and we were talking before we went on air about this, unless they have a conversation with a real person who will ask the questions, I think that is where they're on a very slippery slope.
I think that's a good point. It's a good time also to remind people that we are streaming this live, so if you have any questions, the hashtag is MMWide. We have a question in which probably touches on that point. The question is, if non-advised drawdown is not set and forget at, say, 65, how effectively will someone at 75, 85 or 95 manage their investments?
Well, can I come in on that? I think that's a really important point. And I touched on longevity risk earlier. 1 in 10 65-year-olds will live to be over 100. Yeah. The problem is they don't wear a badge saying, it's me. So whenever you meet a 65-year-old, you don't know whether they're going to meet an early demise or need a retirement income plan that could need to last for 40 years. And that, I think, is a very difficult point. The other point which is often not discussed is the loss of faculty as people start to age. Yep. And it happens to everyone. I'm sure we've all got family members where it's happened. And actually, I'm really interested to understand just how exactly do you go through a detailed drawdown review with someone who's starting to lose their faculty with a number of complex issues around investment returns and managing longevity risk. I think that's a really difficult area.
No, I was just going to pick up on that, and I think that question of cognitive decline, you know, we're talking about it in the context of drawdown particularly, but actually it's a much broader question for the financial services industry as a whole. You could have someone choosing to self-manage their investments in their 50s, going into retirement in their 60s, 70s. How do you identify the point at which they should stop doing that, at which the risks themselves start to become a problem for them? And I think, just to give you an example on that, we have a house policy. If one of our advisors is talking to a client, then once that client reaches the age of 75, as a matter of course, we say to that client, would you like to have someone else in the room? Now, sometimes they take umbrage at that. So, you know, what are you suggesting? We picked an arbitrary age of 75, and that kind of works to a degree as a safety mechanism. But that's on an advised basis. I think there's a really interesting question about how you achieve those same kind of safety nets where someone's self-managing their investments. And I don't pretend to have an answer to that question.
No,
I think, and actually, it's not just about drawdown. It's about a whole much broader question for financial services generally.
Because it is a much broader issue. And so that's where the value of advice and face-to-face advice comes. Because if you're meeting someone who's 68, 69, 70, and the last time you sat down and had a review meeting with them, Tom, and actually you come away thinking, do you know, did that really sink in? Did we have a meaningful conversation? Surely, Tom, by that dialogue on a regular basis, and I know we were talking earlier about review process, a formal, 3-year, 5-year, 1-year review, whatever it is. If you have an advisor in the loop on a collaborative basis, and I'm saying this because I'm an advisor, but I mean, I would do this. Yeah. I would flag it to a member of the family, Tom.
But the interesting question from a policymaker's point of view is, would you presume to tell someone that they must have a regular review with an advisor, and how often and how much should they pay for it? And you get into some quite difficult areas there, because I'm not disagreeing with you. You know, I see the wisdom of what you're saying. But from a policy point of view, where'd you go with that one?
What you need, is a nudge. Now, the one thing that I've noticed, and I was, obviously advising people, for 20 years on this, is what I call the transition through retirement. Yeah. So typically at 60, you start off, you want to be in control and you want to be in drawdown. By the time you get to 75, 80, you want to be in annuities. But it's not, black and white. It's this transition. So as an advisor, as, with a good customer journey, you're prompting people, you're nudging them to review, and actually you're almost trying to sort of second guess where they are, in their own mindset, and it's very complex.
You're trying to help people, rather than pushing them. You're trying to help them by facilitating that and putting those options out there. And one option is your proposition is over here, and there's more specialised people who are smarter perhaps and maybe a higher affluence in terms of money. But the value of advice that people are missing out on the whole picture. Their ISA fund to produce income, their offshore bond to produce income, their cash accounts, they've got too much money sloshing around in cash, all these issues. That's what an advisor should be doing to help those people make that really sensible decision. Maybe they do drawdown, maybe they don't.
I suppose the problem is on the provider side, if you're going non-advised, how far can you go in helping someone and nudging someone to make another decision? I'm guessing you probably feel not that far.
Well, and for our self-managed clients, we do as much as we possibly can to facilitate and to inform, to facilitate their management and to inform their decision-making, and providing them with a multitude of tools and online guides and videos and good quality help desks where they can ring us up and talk to us, and they can talk to real people, and all those kind of things help. But at the end of the day, that individual is taking responsibility, and if they want to pay for an advisor to take that responsibility from them and to tell them what to do, they can do that. But until they choose to do that, they are self-managing, and ultimately the outcomes are their responsibility, not ours. And that is the deal.
I mean, in your defence and Hargreaves' defence, there's some very good quality information. And I think one of the things that I'm impressed with is that you do seem to be able to paint a really good picture of drawdown and how it may develop. But I don't see that from from the insurance companies who, quite frankly, are, trying to sell a product.
To be fair, have less experience of doing this self-managed drawdown business, and so it's evolving for them perhaps. But I think there's some challenges there.
Yeah. I mean, the issue of access to information, Billy, I mean, Dr. Google has a lot to answer for right now, I think, because across the board, whether it's a drawdown or your medical complaint that you think you've got, and doctors are plagued with people walking in with a 6-page report from Google telling them, this is what I've got. No, you haven't. But Google says I have, because I found, and it's like
both ways.
It's like
because
financial planning there. They're finding information, Tom, and going away. That's what I should be doing.
But I mean, that opens the debate more widely into robo-advice, doesn't it?
Let's not get into
That's going to be
We've already done a debate on that.
No.
Simon, you sort of mentioned before, I suppose, the issue probably here is probably not so much Hargreaves' side, but on the providers themselves who've had that relationship for 20 years, and there's sort of maybe the suggestion that they might be hinting, we've got this offer. People might not even call it drawdown. They might just say, I want my tax-free cash, how do I do that? And they go, well, this is our thing. We call it drawdown, but don't worry about that. Do you think the government or the regulator, I suppose, should put in a break point there, basically to boost shopping around? Because at the moment, the stats show that shopping around drawdown is low.
I think it's important that consumers are aware of the wide range of choices on offer. And even in this debate today, even with me here in the room, we're talking about annuity and drawdown and ignoring another category of guaranteed drawdown, which in the hands of a financial advisor can help to solve some of the problems. So yes, I agree. We need to make sure those choices are made clear, what the range of options is, where help can be received, whether that's full financial planning advice with a commensurate fee, or maybe more informal guidance, or the services that are available through TPAS, etc. So I think that does need a lot more airtime in terms of helping consumers with the choices that are available.
On guaranteed drawdown then, what's the profile of customer for that? Does that overlap with some of these? Yeah,
so the typical profile we get is people in the age range 60 to 70, often planning ahead for the sort of income they need in retirement, like to lock in the certainty now so I can get on and just sort of enjoy life without worrying about the vagaries of the market over the next few years, knowing that I have a certain level of income in retirement. And again, what we see a mixture. Some financial advisors will transfer the total fund to us, where the fund might be a certain size, or it might be blended with some drawdown funds unfettered, because then a longer term plan can be put in place for those funds. So again, that's the type of situation we see.
What size typical?
Typical pot size, the average is 100,000. We see 7-figure pot sizes. We see some smaller pot sizes. So
it works all the way down.
It absolutely works, because again, we only deal through financial advisors. So we're in the hands of financial planners who understand how to fulfil those particular requirements that the client might have. So picking up on the point Nick made earlier, some clients now are seeing their pension as their legacy. So they might require a capital guarantee on that and use other assets for income. This is where the role of a financial advisor can come in and really make the difference. I think the key issue is how many clients are aware of the full range of options to them at that really critical point at retirement, but also in the run-up, when actually decisions can be made that can ease the process when you reach that retirement age.
Are there any views on sort of blends, I suppose you might call them, guaranteed drawdown?
It's absolutely the right way to go, because if you're using option here, option B, option C, instead of just going down one particular route. That provides flexibility. Even your self-managed client, you're saying, I'm hedging my bets here, and I get the best of both worlds. And I think that is a really important point.
I find that if you have a truthful conversation with people, they're saying, on the one hand, I do need certainty and guarantees. On the other hand, I need some flexibility and I want the potential for future growth. And for most people, it's a combination. And one of the things that's always surprised me is there's some logic here. With our investments, we don't put all of our eggs into one basket. So why at retirement have people brought up with a black and white choice?
I think that has evolved, and I think one of the consequences of the pension freedoms, and I think the point you were discussing just now about the failure of the shopping around is one of the less welcome consequences of the pension freedoms. But I think there is now a greater awareness that you don't have to do just one thing. Yeah. And as you were saying, Simon, you could put some of your money into guaranteed drawdown, and some money stays unprotected in the markets, or you could buy a conventional annuity. And I think that's the kind of narrative we have to continue to develop with customers. But I think it's also absolutely critical that whatever reforms we can make to the wake-up packs, and I think there will be more to come on that, we also need to try and address this further back up and get people in their 40s and their 50s and 30s, get them more engaged with what's going to happen when they get into their late 50s and their 60s, and take a longer run up at that. And I think that's still something that we've barely scratched the surface on in policy terms.
You're right. Before they have to deal with it.
Yeah, absolutely.
Do it in advance, because a decision made in haste. So married in haste and went at leisure, but
But we know typically people are only looking at their retirement options in the last 6 months before they come to actually make a decision. And maybe if you're just going to employ an advisor to tell you what to do, maybe that works. But were you in the right investment strategy for the last 5 years?
Exactly.
It's that kind of stuff. And have you moved money into the right places? So the longer run up, I think, is something that's not going to happen by accident.
No, it's not going to happen by accident.
Last question for you, I think, Simon. Is there any way, 5-10 years down the line when this product's been around for a while, would you ever go direct, or do you think that decision, that management is simply too complicated?
Well, I think at the moment we're very happy working through financial advisors, frankly, because as I've already made clear, I think in the hands of a financial advisor, you can actually address those issues of longevity risk, which is critical. And I've mentioned the spread of longevity that a typical 60, 65-year-old faces. The sequencing risk, which right now, there are retirees right now suffering the consequences of having drawn down in a bad year that they will struggle to make up. So those risks are clear and present. And we believe that our product in the hands of a good financial advisor can be quite transformational, actually, in terms of what it can deliver. Because there's some really interesting research that shows that quality of life in retirement is correlated with the amount of guaranteed income that you have. And our consumer research shows that over 95% of consumers want some or all of their retirement income guaranteed. Okay, so this is a quality of life issue. The industry is very good at boiling it down to basis points. Consumers don't get basis points. They're interested in enjoying their retirement. And our propositions in the hands of a good financial advisor can really help people achieve that.
Okay, well, we'll have to come back in a year's time and see how your stats change, how your sales are. So that's all we've got time for. So it just remains for me to say thank you to our panellists, Simon Massey, Tom McPhail, Billy Burrows and Nick McBreen. An on-demand version of this debate will be available shortly. Thank you very much for watching.